It looked like, for the most part, kind of muted reaction to a somewhat slightly lower than expected or lower than prior personal income and core PCE numbers. But for the most part, nothing really to stir markets too much. I notice gold's getting a bit of a lift, though, as the dollar continues to exhibit some weakness.
No, it's true. The numbers haven't been too scary here for Halloween. And really, we've seen the dollar come off here a little bit as the Fed decides to step away from rate-cutting cycle. So we saw a dollar weakness yesterday. We're seeing it again today. And I think that may actually be the trend for at least a little while. We've talked over the last few times that we've been together that the dollar's been kind of a two-step forward, one-step back trend higher. I think that may have reversed here a little bit. You know, it gets up around that 98, 99 level, maybe close to par at 100. We've backed off from that. It's been a little bit more dollar weakness, international strength, whether it's Brexit giving the pound a little bit of strength, or maybe at least some consideration that the euro zone might be bottoming ever so slightly, and minor strength there. So we still have the safe haven trade of the yen doing well. But again, the dollar, I think, is really the key one to watch because it's been so strong for so long and many have been calling for its demise. We may not be at the demise portion, but at least a little weaker dollar, I think, is in the offing.
Yeah, coming off a bit over the last couple days, we saw a double top up around that 99.30 level, recently taking out some key levels. A new low for October, taking out September, August lows, and nearing those July lows. Let's talk, Paul, about anything that stood out for you in terms of Fed Chair Jerome Powell's comments yesterday or the Fed's decision to cut rates a quarter basis point.
You know, what's interesting is the comments that he made, he defined very clearly where the Fed is going to act. Whether they're going to cut rates, they're going to have to see some big weakness here in the U.S. economy or material strength in order to hike rates. So I think he put some big bars, or very high bars, for both a hike or a cut in place. And I think that's what we saw, the reaction that we did in the markets yesterday, because I think that really defines now that the Fed is going to be on the sidelines probably through the spring and maybe well into the summer. We'll take a look at that point to see what the economy looks like, barring, again, a growth spurt or a big decline in economic data here in the United States.
Paul, what do you think would it take to change the Fed, for the most part, as you mentioned, seemingly on the sidelines now for a little while? Would it be some bad economic data? Would it be something, or some potentially a downturn in terms of progress with the U.S.-China trade talks? I mean, ultimately, they were pretty clear that they're still data dependent.
Yeah, no, they are. And, you know, interestingly enough, right on the heels of that Fed decision yesterday, we get comments out of China going, you know, we just don't think a trade deal is going to happen. So that's part of the reason for the weakness here this morning. Whether that's going to be enough to tip the Fed, I doubt it at this point, unless we really see the economic downturn really intensify here in the United States. Right now, we're not seeing it in the data. GDP was reasonable. The numbers that we got, the consumer is still pretty good. The weekly jobless claims in line this morning. We get the big number tomorrow, the unemployment numbers, which will be impacted by GM. So again, when we look at the U.S. numbers, they're softer, but nowhere near recessionary. So I think the Fed does stay on the sidelines. But again, if the trade continues to deepen and the rift continues to widen, we may see the Fed step in.
Paul, you mentioned the jobless numbers here and tomorrow's unemployment. Let's pull up a look at those jobless numbers so we can see today. This was the weekly. Again, Paul, what are we going to be looking at tomorrow? Because there's some confusion or expectations, basically, that the GM strike's actually going to have an impact on the numbers tomorrow, and they could come out a little bit skewed. How closely are we going to be watching them, and how much should we consider that as a factor and consideration?
Yeah, I mean, you know, certainly the every monthly jobless number is the most important one, and tomorrow is no different. We're anticipating that it's going to be probably in the 75 to 80,000 range. That's well down, and a lot of that's going to be attributed to GM. What we're going to be watching for the revisions to the back months. They revised the last 2 months. If they revise those higher, I think we're okay. There will be taking those numbers with a grain of salt, at least with the headline numbers tomorrow because of GM. I think without GM, we're probably still in the 140, 150 range.
Okay.
And that has been in line at least with the most recent months. And again, should keep the unemployment number pretty much right where it is at multi-decade lows.
Yeah, slowing some, but not necessarily a major concern. I've got another question for you, Paul, and then we'll let you get on with your day. Bank of Japan, in its quarterly outlook, they said that the core inflation is likely to stay below 2% target. Kuroda said that he made it clear by our new forward guidance for interest rates that we're conducting monetary policy with an easing bias. Not only trade concerns, but also they have some expected impact from the sales tax increase that took effect October 1st. I imagine this has them somewhat hands tied at this point.
Yeah, that's one of the issues that we're seeing globally. When you talk to any of the central banks, whether it's Japan, U.S., Europe, is trying to get above that magical 2% number. None of the banks have been able to do it for any sustained period of time. Cutting interest rates doesn't seem to be the trick.
Yeah.
We're going to be leaning a little bit more on fiscal policy. And so far, many of those regions are really not interested in instituting any fiscal policy, so we're relying strictly on monetary policy, and monetary policy is not going to do it by itself, getting that inflation rate above 2%. So
yeah.
I think we're going to be stuck for a while at 2% or lower.